What's going on, everybody? Chris here. So we're going to take a look at different things like what's going on in the markets come New York Open. I think we're getting in the pre-New York Open, I don't know. I think we're in New York Open right now. But we're going to take a look at the balance sheet. We're going to take a look at anything that's being passed for government stimulus, any possible black swan events that are happening right now, like ideas. Look into what's going on in the bond market. Are there inversions, the credit spreads, the move index, and then we'll look at the dollar. Is it growing stronger? And what's happening with the Japanese yen? That's another interesting one. So that's also fits into the black swan event if the Japanese yen changes their policy. And then we'll look into this lumber to gold. If it's applicable, the COT report, we'll go ahead and move this inside. And the cycles. And then we'll look at the Williams money flow index for institutional money. And it looks like that it's positioned bullish. So I'm ready to enter bullish. And then after some fundamental liquidity and credit market analysis, we can assess like a risk on, risk off kind of environment. And then from there, we'll take it to the technicals, just the context of it with the moving averages, where's price in relation to the moving averages, and then how those moving averages in relation to each other. And then we got the average daily range. Is there an extension? And then the macro range. Because right now it does look like the macro range, the 52-week range, is like relevant because of the chop. And then we'll take a look at the RSI, which is trying to determine like strength in the market of like a certain direction. If it's oversold, a reversal is more likely. So we need to see like the strength of what's going on. And then we'll look at the trend efficiency and then the volatility squeeze if there's one coming. And then we'll look into like a market structure break if there is, or like a swing failure pattern if that's forming. And then I'm adding a new one. It's going to be under market structure break. We're going to call it momentum with the MACD momentum. Specifically the weekly. I guess daily, weekly. We'll go like a fast and slow. Yeah, like the volatility squeeze with the DBT Momo. I'm using that differently for more of like some kind of fake out, like a fake out indicator. Like there's a fake out reversal, and then there's a fake out squeeze where you think it's going to reverse, but then it just keeps going. So I'm using that DBT Momo indicator instead of a fake out, like a momentum indicator, like it's supposed to be. I'm using it as a fake out detector. So after reviewing kind of like the process, the hierarchy, and just how we're going to filter information, let's go ahead and jump on in. So this is the wrong side of it. So this bottom one is the balance sheet. It's just flat. They haven't reduced purchases yet, but we can tell that they haven't bought anything. So there's less liquidity in the market because of that. And then next up, we're going to see if there's any like government stimulus. Last I heard, it was about like them trying to pass a bill before the election year, the Build Back Better bill. And they're just, from what I've heard, that they're having trouble. That they're having trouble passing this, even from the House, I think. So that's pretty bad. If it can't even get past the House, it's not even going to get past the Senate. Just by like, in terms of like the Swiss cheese model of just milestones. So there is no money coming out of the government. There is no like stimulus coming from the government right now, from programs or any bills. And then possible black swan events. There's the Japanese yen changing policy. When they do that, it affects the rest of the market. Usually Japanese yen strength is associated with a risk-off environment. So if it were to get strong all of a sudden, it could signal like a lack of liquidity, because it would be a value play because it's so cheap that people would go to the Japanese yen if appropriate. It's it's very conditional and based on context whether that there is value there. And right now it's really cheap, so that's one part of the value puzzle. There has to be future value in order for it to be valuable, like future growth. And that's determined by the policy of the central bank of the Japanese yen. And then another black swan event would be like a housing market crash because of the rate hikes. And then another one could be any type of existential war. And so I think that's about it. And then maybe oil crashing. We're going to take a look at that. But we're going to take a look at the main index, which is the S&P 500 quality. We'll take a look at quality. And I think that's just the main index we need to focus on. But then we'll take a look at oil. We'll take a look at gold. We'll take a look at Bitcoin. I think I opened that. So oil, gold, Bitcoin, S&P 500. And I think that's all I really need to look at, because we're going to be looking at the credit market, and that's pretty much all we need to look at. And I'm not going to do any technical analysis on the TLT or anything like that. So let's go ahead and move on to the next one. As far as like other black swan events, like they're so hard to find and to like have enough knowledge of like this becoming more and more likely. It's so hard. So I'm not going to even try and expand on that. The bond market, we'll go to credit spread alerts. So I think this is before the market's open. So this is data taken from Friday. We're at 2.1. Look at the 5-day. And we're kind of whipsawing around. It looks like it's moderate. It's not like super scary, but it's like high alert. So it's not like a really risk-on period. It's more of like, hey, like this is a very like cautious time. I think because of the Fed and what they're saying, it's causing some concern of just the direction or just the liquidity that is going to be provided. This year I expect to be just a volatile year, not necessarily to the upside, like a risk on. It just doesn't speak to that fundamentally. A lot of people want to point to M1, M2, but there's a lot of shadow money outside of the banking system. Now we got Bitcoin shadow money. Like, not only do we have like shadow money outside the United States, outside like regular banks, we got Bitcoin shadow money. So like you can't, the M1, M2 I don't think are really reliable. And the whole like inflation deal, I think it's just too, like, it might be present, but it's not really showing in the market, like, per se. Maybe with the 10-year, I don't know. There's a lot of arguments for and against it, to where I just gave up on the issue. And as long as, like, the market structure keeps on breaking down, then, like, I'm not gonna be paying attention or giving much relevancy to those who are, like, they're convicted that inflation is here and it's dominant. I don't even know if that's true, even though they might have all these confirmations to point to. The market structure is not confirming that, and that's like, it's nice that you have these correlations or these confirmations, but confirmation bias doesn't mean, like, you want to be looking for things that would invalidate. Like, if you want to have a solid argument, you want to look for invalidation, not confirmation. And invalidation would be price, like, market structure. So until that's, I don't know, like, price. Yeah. So if we just follow, like, a lot of people love fundamentals. Like, they love it so much that they'll, like, make it their main argument. And the thing is, with fundamentals, there's a disconnect that happens between price and fundamentals, and it could lag, whether price lags or the fundamentals lag. It's just so disconnected that I do not like fundamentals. Like, I have, I guess, I call it fundamentals on my right here. I mean, in my model that I made, but I mean, I could call it best practices. But yeah, fundamentals, I don't know. I think it's overrated, to be honest. Like, for long term, like, being right over the long term, like, I think it's beneficial, but I think some people try to bring it into more of a fast kind of analysis, instead of, like, keeping it in the slow lane. I think fundamentals belong in the slow lane, but as far as, like, in the fast lane, I think more of, like, a best practices and understanding the credit market and liquidity and price is just the way to go, as far as, like, a fast analysis. So that's my take on it. With the fundamentals and then the lag, I think just creates more confusion. I know my technicals are very, like, there's a lot, and it makes people not want to, like, follow, because there's just so much. Just, like, I understand, like, I'm trying to make this recipe from Joshua Weissman on YouTube. He's a chef, and it's just so much, so complicated. I don't even want to make it because it's intimidating. But he's a gourmet chef, so there's an explanation that he fits a certain niche, and there's people that love gourmet, and if I had more experience, then I'll be able to do those things. And it's not that the gourmet is not good; it is good, and it looks pretty. But the thing is, like, it's just not my cup of tea. And I understand when I do these videos, it's not certain people's cup of tea, because they believe that analysis should be simple. And I mean, when you do context is not simple. If I understand people want to keep things simple, so then it's easy to understand, easier to come to a conclusion of a thesis. But context in itself is not simple, because there's multi-facets in it. But and that's kind of why I made this model. Like, I understand that the credit market and risk on, risk off period have a big effect. I understand that government stimulus have a big effect on the market, and then also technicals and price action. And I tried to there's two ways of incorporating price action. One is more of like a mean reversion, and then another one is like trend trading. So I incorporated trend and mean reversion with market structure break and then the range. So it's very complicated, and I'm trying to make a comprehensive kind of model to where I can have the best bet going in, because there is no certainty day by day. Like, you can build certainty through your context, but that's some people, they just need RSI and then maybe some moving averages, and that's it. And then they check the news and then make a bet. And sometimes people's internal computer, or intuition or induction or deduction skills are just that great, because maybe they have as much experience as Larry Williams. But like I watch anytime that Larry Williams puts out a video on stock charts and on from stock charts on YouTube, I watch it, and there's some his insights. He says he's got 50 years, but I asked him, hey, I told him I don't understand how you could see through all the data, the signal from the noise. And he says that he thinks that maybe it's because he's been looking at charts for 50 years, and that internal computer is just so strong that he's able to determine what it's really saying, versus from all the noise of maybe disconfirming and confirming signals. So for some people, they're able to make it simple. For me, I can't, because it's I believe in context, and I think context is multifaceted, and I want to map it out, just like people would map out the different companies and how those the market map with the big to small cap companies and how it affects the price. But a lot of those are more reactive versus being a little bit ahead and accumulating a position. So let's go ahead and start. So we've already finished this top block. So the answer is there is no change to the balance sheet. So that keeps it simple. And there is no new stimulus being put out by the government. Nothing has really passed other than the sanctions on Russia and maybe some other bills, giving money to Ukraine. That's it. And then black swan events, other than Russia invading Ukraine, I can't. And then I guess oil spiking. There hasn't been. It's been unchanged in black swan events yet. Bond market. We looked at the credit spread alerts. We're on alert. We're not being too aggressive, but there is concern in the credit market. And then 10 and 2 year, it inverted, but the percentage of inverted, what's it called, bond. So we want one that's got both of them. The daily. Huh. Okay, did I used to have it here? On this one? Yeah, I think that's it. Yep. Okay. Maybe I only need the weekly, because I guess I don't know. I think I only need the weekly. So it was starting to elevate last week, and then when the market started going down, it started to abate on the percent of bond yield inversions. So that's good that it's not continuing to go higher, because that means there's less inversions. Less inversions means there's less concern in the credit market as the price of the market goes down. So right now it's low, and we're on alert. And then the MOVE index, I think, is down. We want to see the MOVE index, and we want to see it with let's see, range. Let's see it with range, I think. Oh, no. We want to see it with a unique ticker. Yep. So we'll turn off this indicator that is in here that's drawing all of these channels. Okay. So as long as we close, it looks like it's forming a symmetrical triangle, and it could be breaking out this week. This week is supposed to be really, from what I've been hearing, it's like a big week because there's a lot of earnings. So I think I like, it's not Twitch, it's StockTwits earnings. So I think I like StockTwits better than Earnings Whisperer. I don't know why, but we got on today. It looks like Activision, Coca-Cola. It's supposed to be a big one because we got Microsoft, Google. We got the FANG, basically, almost like the FANG stocks. Friday is going to be the kicker because it has to do with oil. And Abivai, that's, I think, healthcare. But Twitter on Thursday. But lots of big companies. Let's see. Maybe like Earnings Whisperer will tell us. Yeah, let's just do that. Okay, so I think this is a highlight of like the biggest companies. So we got Apple on the 28th, Microsoft on the 26th, Amazon on the 28th, and then Google on the 26th, PayPal on the 27th. So just a lot of big names. Calendar. I want to see a weekly list. See, like the view. And it only does it day by day. Like, I know, like, Twitter, on their Twitter account, they did a good job of displaying, like, the big names. Okay, this looks like it's it right here. So, Monday, it looks like the biggest name is Coca-Cola out of all those. And then Tuesday, we got Microsoft, UPS, Google, Visa, 3M, PepsiCo. So, that's going to be big. Wednesday's also going to be big. Boeing, Facebook. We got PayPal, Spotify is like there's a lot of traders in that. And then Thursday, we got Apple, Amazon, Intel, like a semiconductor company. And then Friday, we got oil, and then Abivai, AstraZeneca, some healthcare. But and then we got a representative of Jets. So we're gonna see just this week, just what's happening. I think there's the next week too. Let's see if nope, they don't show the other week. I thought that's not the calendar. There it is. I don't know. I was thinking the 2nd through the 6th was like a big earnings week. Let me see. Yeah, so the 2nd through the 6th, we got AMD, Starbucks, Pfizer. So it's a lot of healthcare, defensive, Square, Neo. So the earnings these 2 weeks are going to be really interesting. Um, we'll take a look at the model and just go through it all. But yeah, I don't know what got me into looking. I think we were looking at the move index, but yeah, move index. It looks like it's up. I'll just kind of get back on track. We were on unique tickers. Move index is up, so we're gonna just kind of be on alert, not go too crazy. I guess whenever I get in a trade, try to take profit quick, and then move the rest to break even if I'm building a position, and then just play the market structure breaks day by day. But right now, it looks like the credit market is very tight and illiquid, or at least the fear in the credit market is elevated. It's not like risk off totally, it's just elevated. And what makes me think that it's not risk off totally is, I guess, junk bonds versus TLT. So right now, it's looking bullish on junk bonds. So junk bonds are something that's more of a high risk than getting a bond from the government. So there is risk taking out there. It's just it's like sporadic and it's hard to find. And then also people are, I don't know, they just go in equities all in. I don't know, we'll go through some unique tickers. Let's go ahead and take a look at lumber versus gold. I mean, that's the next in the diagram. We already went through most of the credit market. So right now, it looks like gold is winning against lumber, which is associated with growth when in building. So whenever people are confident and people want to take on risk, they'll build more. When they are fearful, they'll buy more gold. And usually, increase in gold is associated with in recession. So right now, the strength of gold is building. It's not necessarily cemented, but it's building to where it's forming a pattern. And right now, it's kind of in no man's land on a high alert kind of thing. And we need more data. We have to be more patient to see it flush out, and we'll know when it flushes out is when it turns red. That's how I determined it. But an early sign is when it closes below this high, and then it starts forming resistance. This moving average channel helps me determine if a swing failure pattern where there's a deviation, where there's a trap of bullish buyers that got trapped. So that's like the Cathy Wood people. They're trapped, and as long as this stays below the yellow line, they will continue to be trapped until something changes. And it always changes, like as you could see, it's never fixed. But we'll continue to monitor it. Okay. And then we took a look at lumber versus gold. We can take a look at gold versus the market versus gold. And then we can take a look also at some other things. So it looks like the market is losing against gold. It has a very similar pattern to lumber versus gold. And we got to see where the quarter closes. But it's under that last high. This is the deviation. And for the pattern to be true, where the market is wrong and gold is right, we want to see it have resistance at this previous high, or 0.246, and then we want to see it break down and close the quarter below this low to break the market structure and then retest it here and then resume down. I mean, it could go all the way here and then retest here at this wick low and then get rejected there. That's also a possibility. But as you can see with the noise here, noise indicator, it's just choppy. That's the same with lumber versus gold. There's no clear winner. It just means we have to be patient to see what happens. Like, there is no clear winner right now. So it's safe to say, just from the bond market, the credit market, to here, there is no defined high performer. And then let's go ahead and move on to the next one. So another thing that people have been paying attention is growth versus value. So growth is associated with risk, and value is more of associated. It's also like a risk-on asset, but it's more of like a safer risk asset. Like, it has to do with, it's very defensive. It has to do with like consumer staples, things related to that. So this is not growth versus value. This is. So it does look like, so value is when it goes up, because IWD is first in the pair, IWD divided by IWF. IWF is growth. If growth is to be dominant, you want it going down. So we're seeing a double bottom, and then depending on where the quarter closes, it would signal a rotation on the fast signal. I have a fast and slow. This is supposed to be 6 months. The slow's the 6 months. So the 6 months never had like a false signal, and this quarterly has had maybe 1-2 false signals. But the thing with the fast is you don't bet big on the fast. You bet small, and then you build a position as it confirms with every quarter. So we're waiting patiently to see what happens in 2 months and 6 days, whether value takes over growth. So it's inconclusive right now, just like gold versus the market and lumber versus gold. Everything is just up in the air. No one really knows. So like, it makes it very confusing in the market, and that's kind of why people are like, what do we do? What do we position for? Is this an inflationary period? Is this a deflationary period? Is this a recession kind of period, bear market? Like, what do we do? So it's really difficult to pick a top-down environment, and that's why most people go bottom-up, which is they pick the company, they find something that's got value-based fundamentals that's very strong, and then they buy, and then they buy when it's on sale. So that's like, it's, if you were just a casual investor, that's like the best way to do it right now. It's really difficult to determine when something is absolutely risk off. I think the percent inversion yield curve is the best signal, and right now it hasn't gotten over 60%. It's at like 5 or 10. So like, if you have the cash flow or the means to be buying when stocks are on sale, quality, or whatever you buy, it makes sense that going bottom up and making sure you get good quality companies fundamentally is not a bad way to go about things. But as far as like Bitcoin, risk on kind of assets like S&P 500, like I don't know, like I'm not committed right now. This whole year, with the volatility and the statistics behind just the events that are happening, like the election, this being an election year, I don't feel comfortable with any kind of committed financial decision until after the election's done. That's just me, but like I'm not gonna FOMO on anything that rips or anything. Like I think the forward EPS earnings per share is still a multiple. It's still above average. So until there's like I guess a touch of the 100 simple moving average weekly, I'm not gonna really jump in. So, but I think there's an 85% chance that it could touch the 100 weekly. We'll see. So I'm just drinking my coffee. We'll take a look at the cycles and the COT report. So COT report is also confusing. I think, he's got a data grid as well. But it looks like British pound's long. And then if we go to the data grid, it looks like Japanese yen is short. And then British pound, it's looking more favorable. But yeah, as far as like the table bias, it looks like people are long Canadian dollar and British pound, and then short US dollar in some aspects. I want to look at Euro US dollar because that's been a tell of just so it's same direction. So it's I don't know the same direction. I just count as a wash. There is no. It's just choppy. No one knows. But it does look like people are favorable to either Australian dollar against the Canadian dollar, short the euro, long the British pound, long the Canadian dollar against risk-off assets like the Swiss franc or Japanese yen. People, what's weird is like the COT bias is like short the Japanese yen, but like on IG, people are the sentiment. How do I get rid of this? The sentiment is like long the Japanese yen. So, the sentiment is like long. I think. So Euro USD, USD JPY. So, net short. People are more short the US dollar than the Japanese yen. So that's something interesting. And then people are more long the euro versus the US dollar. The 60 or 80-20. Yeah, so that's like really interesting. I don't understand that. Like, I guess they're just seeing that the US dollar is overbought, and it makes sense. And if we were to take a look at the dollar, because that is the next that we haven't looked at, the dollar, and then the cycle. So we just looked at the COT report, look at the dollar and the cycles. But yeah, you could. So the credit market's very, very mixed, and that's why we're on high alert. We don't want to be making super big trades, and we want to be like more patient. But we're gonna look at the dollar, and I think looking at it with the noise is the best one. Dixie. So we want the one also that's got. I think it's the range or the proprietary trend. Let's go proprietary. I think it's got those lines. Yeah, this is the one. So look at the Dixie. We can use this one because it's got my fake out lines. So depending on where the quarter closes is just I'm thinking it's gonna reach this high here, this swing high, and then it's gonna, I don't know, it's gonna close up here, and then that's when we get bearish, and then it's gonna come down. I don't know, maybe it'll come up here and then it'll make a bull flag. So once it gets here, then we'll start to begin building our shorts on the dollar. But usually, whenever people are short the dollar, is when the market goes up. So that's something to kind of incorporate in just my trading for bullishness. Is when we hit this wick high on this index, which is in, like, it's US dollar versus the euro. Once we hit this high, then we can begin going risk on. We can start thinking risk on. Right now in stock charts, we're seeing a lot of accumulation of a position for the bulls on the institutional side. And I'll show you that, like, right here. If we go here, you can see on the Williams Money Flow Index, if I were to enlarge this is the daily. We're seeing some bullish bias for institutions right here on the Money Flow Index, but we're not seeing any kind of bullish divergence in the accumulation index. So right now, I think it's just a little early, but they're starting to accumulate a position. They're just kind of waiting until things bottom out. And my hunch, it's going to be the 100 weekly. We'll take a look at just what we're dealing with, but everything's below these moving average channels. Like on the monthly, we're below it. On the weekly, we're below it. So I'm thinking we're going to touch the 100 weekly because it basically is signaling it wants to trend down. If we get another weekly close below this moving average channel low on the monthly and the weekly, it wants to trend down. So there's a high chance that it's going to go touch like the 100 weekly. So we'll continue to monitor that, but and who knows where it would stop. But according to like the credit market and the bond yield inversions, it doesn't look like it's set to crash just yet. But it's going to pull back. We just don't know how far, and I've made a guess. So we took a look at the money flow index for the S&P 500, and then the cut report in the dollar, what we think will happen, which is it will, if we go back, we think it's going to do a double bottom bull flag, and once it hits this back, so it's called a bulldog, this is the back of the bulldog right here, and then this is the tail, and the tail high is what stops it from going higher, and it starts to form a bull flag, and then that's when we'll start to see the market having trouble. But I think it's going to move really slow, and we don't know how high it'll spike up or what, but it does look like it's unpredictable, but it's bullish. That's the best way I can say it. It looks unpredictable and it looks bullish until there's like market structure breakdown. We don't. And the best way to determine that is watching Euro USD, and following that structure. And we could pull that up. I mean, let's see. Let's pull up Euro USD. So that's something we'll watch. So I'll open a daily and a weekly. So a 4 hour and a daily, and then a daily and a weekly. Okay. So this one will be the daily and weekly. So it does look like it's more stronger the dollar. So until we have a significant break on the weekly, I don't think the trend's going to be changing. Or even the daily. like as like a fast. Yeah, it's looking like it's breaking down. Oh yeah, like it would be nice to have a weekly MACD going. But yeah, like as you can see, it looks like there's a lot of dollar strength, and we're waiting for a market structure break on the Euro USD, and it doesn't look like it's anywhere close. The stronger the dollar gets, the weaker the market gets. That's kind of just what we're seeing right now. Until that flips, we won't see like risk on kind of appetite. We were seeing a possibility of a risk on appetite, but as you could see, it got rejected by that 24 moving average or that daily bearish order block in orange, whatever. But the dollar is growing strong, and that's probably why you would see, what's it called? Gold not doing so well. It's because the dollar's doing so well. So that's like a really interesting kind of facet. But overall, if I were to sum up, so we do have to go over the cycles. So this is current to today, I think. We could zoom in a little more and like see the 22nd. So that's last week. It's still enough. Let's see if we find it today, 25th. It's right there. So it does look like, according to the decennial and the annual, we're almost at a valley or a convex kind of. So then we're looking for some kind of bullish pump. And then come the end of the first week of May, it does look like a concave in both decennial, annual, and I mean, we could call that little hump a concave for the 4-year. So it does look like we're going to see some whipsaw action, and then come the first week of May, that we could see some kind of downward movement in the market. We don't know exactly what day, but it does look like it's going to take place on around those after the big earnings. After that's done, we'll see maybe some kind of definitive direction, and it does look like it could be in the downward movement. So I'll be looking to sell short any kind of market structure break from whatever the bulls do. If the bulls set something up, I'm going to short it. But it does look like it's almost time to get ready to get a little bullish. And then we got to figure out, okay, the resistance, most likely it's going to be here at this last low. And then we'll see what happens. But let's go ahead and move on. So we saw the cycles, the COT report. It does look like the credit market's mixed. It's not strong. It's not saying risk on. We do have some spotty risk on stuff like junk versus TLT. But we're seeing a lot of uncertainty. Not anything that will put us in a recession and crash, but enough to have a pullback in the market that's significant. And we're getting no real bullish signals from like the government or the central bank. If anything, we're getting rate hikes, so that's not necessarily bullish. And so then in the COT report, it does look like people are positioning. They're trying to get short the dollar on the institutional side in the COT report. So we're just going to continue to monitor the dollar. But it does look like it has more upside to run. So I can expect more weakness in the market. And that's giving me the thesis or like some support for the thesis that we could hit the 100 weekly. And then the Williams Money Flow Index, we're bullish for the S&P 500, where they're taking a bullish bias. And it does match with the cycles. It does look like we should get I mean, I've already set up my bot to go bullish. We'll take a look at the bot in a second. But as you can see, we've kind of already have like a good thesis going into the week so far. As far as like the moving averages, I think we're below all significant moving averages on the S&P 500. If you want to look, we can look. Let's go to the range, and then this is the daily has the 72, 24. We'll take off the moving average channel and the 200, and we're below all of those. And it looks like the 72 is about. These are all simple moving averages, and it looks like the 72 is about to cross the 200. So, and then as you can see, also it does look like we're in some kind of symmetrical triangle, and I imagine that. With the symmetrical triangle, it's going to turn into like inverse head and shoulders. I don't think it made the head yet. And that's what makes me think we're going to hit the 100 weekly. That's going to be the head. And I think that's around 38.80 or right around this 1.13 range. And I'm going to be a buyer there. And I'm betting that because the percentage of inverted yield curves is not near 60, and gold is not spiking, that's going to be the low. And then I'm going to ride the wave into Q3 and Q4 all the way up. And I'm going to try and kind of ladder a position going from a daily trailing stop, 4 multiple, 9 period ATR from the daily and weekly time frame of trailing stop position. 1/3 weekly, 2/3 on the daily, 4 multiple, 9 period trailing stop. And what's weird is that I guess on my broker it's a little broken, and the 4 multiple turns out to be like a 2.9 multiple. So that's just how weird it is. So that's the moving averages part, and that's that kind of context. It doesn't seem bullish, and it seems like the moving averages are pinching together, and it looks like trend is not really strong. And I started out as a trend trader, and trend trading is hard because the fake outs, like you just get frustrated whenever it's not trending, and this is a pure when it's not trending. Another tool that I use to determine trend is like this bow spans or something. Let's see. I think I made a new one, but it's this one, trend. Oh, it's right here. So I'll get rid of this one. So this has got a couple things. We'll isolate them. So the first one is just the moving average channel, the weekly and the daily. I got the high and the low. It's just below all of them. If we get another weekly close below the weekly, there's a high chance if it closes below this blue low 10 period weekly moving average channel, that it's going to continue trending down. So we're already positioned to trend down on the slow time frame weekly. So that's significant. And we could bounce here and then close the week above the 10 low, and that's good because then that means we'll reach the other side. And I would prefer that because like the higher I can accumulate a position, the better. And that monthly open will be a lot of big resistance. But I would prefer to accumulate a position up at this monthly open if possible, because it does look like we're forming a symmetrical triangle. Maybe this week's earnings are positive, and then the first week of May is negative, and then we come down and we break through. That's a possibility, and I'm kind of hoping for that because it would enable me to get the best position possible. through all of the chop, and it does look like, according to the cycles, that's highly likely. According to the math cycles, it's highly likely. And according to the institutional buying, it looks highly likely that we're going to be seeing a bullish swing, and I'm thinking it's going to be right into that monthly open, and I'm expecting some resistance there, and I'm going to start building a position short heavily. So that's kind of like the trend part of the moving average channel, and if we were to instead put on the bounce bands, we could see trend in a different way. And the way this works is that whenever the blue band is in the green or touching it, it's trending. And it's right in the middle for the slow and the fast. So it's very choppy. So that it's a good indication that we're in a consolidation pattern, and it does look like a symmetrical triangle, or it could be a bull flag. But I would like to think it's going to be a symmetrical triangle, and then it's going to make a swing failure pattern and then go bullish. But we'll see. It's not definitive just yet. And if it is a bull flag, I mean, I'm ready for it, like to hit that low all the way down here around 38.80. Let's see. Oh, right here. So it does look like if we were to hit the low end of that bull flag, I'll be ready to go bullish. Like that's it. But we have to wait until it flushes out. And I do have like a naked pivot down there. So it does on the H4, like a market imbalance. So I wouldn't be surprised if it were to go down there, because it's like my target for my shorts. That's how I determine my targets. So then now we saw trend. Trend is very choppy. The moving averages, the ones that I follow, 24, 72, and the 200, they're starting to pinch, and it does look like trend is weak. The average daily range, there, I don't think there's any like big extensions. We'll take a look. So for the ADR, it does look like we're extended on gold today, right now. A little bit on oil. So I think it's gold is falling, and I think that's why it's extended. We're going to take a look really quick here. And it does look like it's falling. It looks like it wants to close the day below the 72 moving average. And we could probably see a huge swing failure pattern coming out of it. So I wouldn't be surprised if it starts trending down on gold. So that's what's happening with gold. It would be interesting if I did a market structure break entry on short on gold. So we'll continue to monitor it, and it does look like the ATR is flipping bearish on the daily. So that would be significant for beginning a position on gold. Gold is super volatile, so I don't trust it as much for like an entry on a faster time frame other than the daily, and then the slow time, the weekly. But yeah, gold looks like it might be appealing to the short side. So now going into the macro range, we're gonna take a look here. Range. So we got a couple of ranges, but well, on the weekly, it doesn't look like we have any. On the noise, I put a range. I put a 2-year range and a 52-week range. So as you can see here on the 2-year range, we'll kind of minimize that. We are getting close to some support, 0.246. So I mean, it's, if anything, we'll be expecting some resistance at this 0.13. And then if we were to go to like the 52-week range right here, we bounced off the 0.382 fake out fib, and we're right now at the 0.618 golden ratio support line, and we could see a bounce here. So I am actually thinking about buying like around here, and seeing what happens. I'm expecting some kind of symmetrical triangle playing out, and I have it looking to buy. Oh, it already bought. Okay, so it already bought. It does look like I'm being squeezed right now. So it bought 0.02 lots and made my stop loss there, and I'm being squeezed. So we're going to see what happens. I think a lot of people are expecting it to go short. If we end up going into this ADR, like, I wouldn't mind trying getting back in. I think I put my positions small enough to where I could absorb the loss if it ended up being the wrong day of a market structure break to get in. I did put it at like a little bit of an unreliable, a little bit of a faster entry on the H1 versus the H4. So we'll if it's wrong, I'll switch it to an H4 entry. Just because, like, you can only be wrong so many times, you can only take a loss so many times of your position before it's just no longer profitable. So if it doesn't work out today, I'll just increase the time frame market structure break and then go from there. But we've looked at the macro range. It does look like we're in some support range. We're near the weekly low. If we reclaim this weekly low here to the upside, it would be bullish. But whoa, man, it's getting aggressive of punching down. So we're gonna see a lot of volatility. I might be at a loss on this entry. We'll see. But relative strength indicator. So that's looking bullish because it looks like we're getting close to oversold on the daily. Maybe we need some purging of the stops here in order for us to get bullish. We need some liquidity to be hunted. So maybe that entry was a little quick, and I'm gonna see that it was too quick, and we'll learn from that experience. Patience really pays. So sometimes I just need to learn a little more. Volatility squeeze and trend efficiency. It does look like there's efficiency building. If we go to this chart here, no, we want the noise. Let's open up this again. So on the monthly, it still looks choppy, but on the daily, it does look like it's starting to pick up. It looks like it wants to go down more. We're still in we haven't closed the month yet. We have 4 more days to close the month. If we do close below that low, I could see trend building to the downside. But right now, it doesn't look conclusive. And according to the cycles and the institutional buying, it does look like there's a good chance we could reverse from here. And also the RSI. It does look like there's a good chance we can reverse from here. And also from like a symmetrical triangle standpoint, it does look like we can reverse from here. We're at support. And also from the 52-week range standpoint. So there's a lot of context pointing that there's a possibility or probability that we could reverse. And then the volatility squeeze. So on the daily and the weekly, it does look like it wants to pinch down. We are getting a bullish divergence on the weekly, so it's actually really interesting. The weekly divergence is like usually a good signal at times, not all the time, but as you can see here, it worked out there and it worked out here. So we're going to continue to monitor it, but we are getting a squeeze to the downside. As far as like where it stops, I don't know. But we look at the H12 and H4. Maybe if we get some bullish divergence on the H4, maybe it makes more sense that we'll be going more bullish. But we are getting bullish divergence on the H12, so it is positive. It's like a positive sign that we could reverse to the upside. But right now we are getting a squeeze. So maybe now today was not the best time to get an entry, and just wait until the squeeze finishes and then get in. So like right now it does look like it's a little too early when I set that bot up, but we'll continue to just see if it survives. If not, I mean it's small enough to where it wasn't such like a big loss. So that's something interesting that we're going to continue following. So I think for the most part we've finished the blocks here. As far as like momentum for the S&P 500, we've crossed down on the monthly MACD. So wait, let's change this settings because that's not what the other ones are. 3, 10, 16. Okay. So it does look like we crossed down on the monthly and the weekly and the daily. So it looks like right now we're pointing down. The momentum's to the downside. I mean, if we look at the weekly chart on that those down candles, it looks pretty bad. But it also looks like there's gaps. So what's going to happen is that it's probably going to fill those gaps. And it looks like the will trend just flipped bearish. So we could come all the way up to this orange line or around thereabouts, or this the top of this will trend, and that would be really good shorting, a really good shorting position. And then, but as far as like a faster time frame, like the daily, it does look bullish, both from like we're in a bearish sentiment and we're getting bullish kind of institutional buying. We just need to see accumulation, bullish divergence to happen. And also, like the monthly, it does look like we're accumulating or we're bullish, but we're waiting for things to flush out on the month before really getting excited about that. We could, before the month closes, tap that 100 weekly. It really, we'll kind of see, and that might be that squeeze that we're expecting to the downside. But that's the momentum. The momentum looks like it's down, and it looks like it's squeezing to the downside. So we could possibly see before the close of the month some kind of stop hunt all the way to the 100 weekly or the previous low of the past 3 months, which is down here 38.80. No, around 41.25. And then next, what's it called? Is market structure breaks. So we'll take a look at the market structure breaks. We've seen the RSI so far. Oh, look, it looks like those bullish entries are wrong. We're about to get stopped out. Let's lick my wounds. Yeah, that kind of sucks. But we'll go ahead and look at the weekly. So the monthly bearish order block is here on the S&P 500, and I'm imagining the Bitcoin's weekly bearish order block is there as well. Oh, you know what? We don't have the monthly on here. Let's go ahead and put on the monthly. So, I think we have it on the weekly, but not on the Bitcoin. Yeah, maybe we need to start putting some monthlies in there. So we want to see the Bitcoin. Let's see. Bitcoin. Where is it at? So Bitcoin's also near. Let's get rid of some of these horizontal lines. Okay, so it does look like we're getting close to the monthly bullish order block. If we close the month below, that wouldn't be good at all. So we're going to be watching 37,263, and it does look like there's a gap around 24,000, and it could be defended, this gap. So we're going to continue to monitor it, but just like this gap was defended on this high, this gap on the low could be defended just as well. So we're going to continue to monitor it. It does look like it would be a really good entry for a long here. So for a leveraged long, and also some spot buying. So I'm going to continue to monitor it and also get ready to trade to the long side. I'll be excited if we get down there, but it's going to take a lot of time. My estimation is like Q3, Q4, that would be a possibility if we had a monthly market structure break. So that's something I'm keeping my eye on. And then also on the S&P 500, it also looks likely. We're going to watch how the month closes. And then on the daily, I mean, we don't really have any market structure. So my buys got hit. So yeah, it does look like that there's no new significant order blocks that need to be broken on oil. If we break the weekly here, that would be significant, but we'll continue to monitor it to see if there's any weekly breaker. If there's a weekly breaker, there will definitely be a change in trend, and it would definitely be some kind of signal of a recession. But until that happens, we're going to continue to just go with the flow. And then we've already discussed Bitcoin. We're on a bearish breaker right now, and we're waiting to see how the month closes on gold. We're dipping into a weekly bullish order block, and we'll see if the daily order block breaks, and then the weekly order block breaks. And then Euro USD, we're waiting to see if I guess we need to see the monthly, right? If there's a monthly. So the monthly order block is bearish. So it does look like it's bearish overall. Let's take a look at the Euro USD with right here. See what's going on. So it does look like there was institutional buying for bullishness, and I don't know, that lower low doesn't look like a bullish divergence. This however does. And I guess like if we had a cross up on the weekly MACD, it would be a good sign for some a bullish move and maybe a possible swing failure pattern like happening right here. That could totally happen, and that would bring strength to the market. But right now, it doesn't look good. We are closing candles below the monthly moving average channel, and we got to see how this daily closes. But on the weekly, we're also trending down beneath the moving average channel. So we have to see how things play out this week. It looks like this week or next week we could see something of a bullish like nature according to the earnings and also the cycles. But we'll kind of just be on standby. I think these 2 weeks are going to be really mixed and volatile. So just like you saw me get stopped out, I think that's going to happen to a lot of people during these 2 weeks. So just have a lot of patience, trade really slow until I guess a higher time frame significant event happens, whether it be market structure break or like a reclaim of a level with a higher time frame. So I think that's pretty much it as far as just things that I'm positioning for. I think I'm going to just try and play the symmetrical triangle in the S&P 500, and then the goal is just to accumulate a position. I think I'm gonna sell if we get any more of a deeper dip in the S&P 500. I'm gonna sell like half my position, and then if we go back up, I'm gonna try and accumulate more. But that's pretty much it, and we'll see how that goes. So thanks for watching. To the most things that I'm gonna pay attention to is we got earnings on these 2 weeks. I think we got a rate hike on the 7th of May. I'm not 100% sure on that. And then we got, I think that's it. And we got some math cycles that are telling us something's going to happen within these 2 weeks. And we got a monthly close. So we're going to see maybe if there's a monthly breaker. So that would be significant if it is. So that's pretty much it of what I'm paying attention to. And you got an overall sense, like it looks like it's leaning bearish. Credit market's mixed, and risk on, risk off appetite's mixed, and it's very choppy and unclear. It does look like things are literally consolidating into a pattern, and I'm just playing the pattern and making money on the buying low, selling high. So it's just a matter of entries and just I guess following the institutional money. The institutional money bias is selling us look for a bullish break. So I think that H1 breaker didn't work out. I'm gonna go for an H4. So that's the next move for me. So thanks for watching. See you in the next video.